Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this short video, which will summarize our January 2024 Assured briefing, at least a major portion of it. I'll explain. Recording this video in mid-December, but we release our January briefing because of the holidays early, and that is usually before the holidays and well before the first of the year. And in our annual January briefing, because of people's interest in perhaps spending time doing things other than work, we include a section called Trendspotting, where we include a large number, maybe 20 some graphs of kind of across diverse topics, all of relevance to property casualty professionals. And we do what we try to do throughout the year, which is to find diverse sources of information, marry that with insurance data, or at least view it through an insurance, property casualty insurance lens, and then ask, ask and hopefully answer what's the relevance for property casualty insurance professionals. So we're going to give you a sampling of that now. Bear with me while I switch over to the to share my screen. If you are a subscriber, you'll have the briefing, and we hope you enjoy it. If you are not, feel free, especially if you enjoy this, enjoy what you see here, feel free to reach out to us. We'd be happy to start you on a trial. So let's dive in. Inflation, a topic to state the obvious, of concern to everyone for the last few years. Medical inflation, it's been coming down, recording this just after the release of November inflation data, which showed it continuing to decelerate. Favorable commentary from the Fed about possibly lowering rates in 2024, and the markets are responding favorably. We don't disagree with any of that, those biases, but we are probably more bearish than the typical pundit out there on medical inflation for a variety of reasons, which is in our research. But here, what we're sharing with you is just the tracking that we're doing of medical inflation as it pertains to workers' compensation on the left, and on the right to auto bodily injury claims, really kind of any injury claims. Essentially what we've done is taken PPI series and weighted those together as different series, inpatient costs, outpatient costs, ambulatory surgery centers, diagnostic imaging. You get the idea. Weighting those together in ways that are most relevant for workers' comp claims on the left, bodily injury claims on the right. The main takeaway is volatility has increased since the start of the pandemic. They clearly were biased higher for a while. It does appear, as I'm looking at my cursor here, it does appear there was a strong tick downward in the fall of this year, and although it's ticked up in the last reading, it's still kind of below the moving average, and that's a good sign. If the next month for December is kind of neutral, stays the same, or certainly if it goes down, that might say that we're reaching a peak for the series, at least a local peak. So we'll be watching that. Medical inflation's higher than it was before the pandemic, but if it's in the 2.5% to 3-ish% range, probably that's not going to raise a lot of alarm bells for property casualty insurance professionals. We will remind, though, for workers' compensation, that it's important to watch the gap between wage inflation and medical inflation. When wage inflation is higher than medical inflation, workers' comp insurers are getting an implicit rate increase as policies renew. But because the Fed is so very focused on wage inflation, and it has been coming down, we have this positive bias toward think that medical inflation will go higher. That gap could shrink, and when that gap shrinks, it's an ever lower kind of implicit rate increase that workers' comp insurers are enjoying. And of course, if that were to reverse, with medical inflation being higher than wage inflation, that would have the opposite effect. That would actually harm the margins of workers' comp insurers. So workers' comp professionals will want to watch that wage medical gap. Turning to social inflation, a topic we've been following for a very long time now, as I'm sure many of you have been as well. We wanted to share a really interesting data set from the Minneapolis Federal Reserve. Um, they were able to, with all the appropriate approval, governmental approvals, no doubt, marry tax information from 1990. We're only showing 2000, but I believe it's from 1990 to 2019 presently. Tax information with demographic information, um, age, gender, um, race, and ethnicity, I believe, are the major variables. So if you believe that social inflation trends and measures of inequality can influence nuclear verdicts, this is a data source you'll want to mine. What we're showing on the left is comparing two demographics and their earnings at the 50th percentile. You see demographic one, where demographic one, and it's very regionally concentrated, is earning more than demographic two. We're not worried, from our perspective. We're not worried about the demographics specifically. From our perspective, what's important and valuable is that they are there to be analyzed by actuaries, claims professionals, and maybe even legal teams at insurers and reinsurers. And on the right, you see the trend since 2000 of household income at the 50th percentile level. Um, what's relevant here is if you ask the question, why might one demographic view the last decade or so differently than another demographic? Well, look at the gains that in income that demographic one scored over demographic two, and you might give some insights or help you understand why one group of people might view the last decade or plus better than, more favorably than another group. You didn't know, mesothelioma can be inherited. That's you don't have to rely on us for that. Yeah, that's from the American Society of Clinical Oncology, which acknowledged the same in 2020. Why is that relevant? If we're speaking to you and you're at a company that has legacy asbestos liabilities, either keeps them net or in most cases, analyzes them on a gross basis because they're reinsured off to a legacy reinsurer, you'll still, even in that latter case, you'll still care about them insofar as there are probably limits, reinsurance policy limits on what can be ceded. And if this is all relevant, you do an annual asbestos study. And what we're highlighting here is that the science behind the connection of external exposures and various cancers that are the subject of mass torts, that science is changing rapidly, and it really pays to stay on top of it. So just in the last few years, it's been acknowledged that mesothelioma doesn't have, if somebody unfortunately has mesothelioma, you can't conclude definitively that they must have had some asbestos exposure. In fact, over on the right-hand side, you see up to perhaps 12% of mesotheliomas are linked to genetic mutations and naturally occurring genetic mutations. So there's a lot of science there. Some will strengthen the ties between external exposures and bodily injuries. And some will go the other way and maybe loosen those ties, or at least acknowledge that some people's cancers weren't from an external exposure, but instead were from a naturally occurring genetic mutation. We think it should be factored into actuarial work. This is really interesting. Fatality rate, very sober topic, but still very interesting. Auto fatality rates in the U.S. are meaningfully higher than in Europe when viewed on a per population basis. The blue line is the U.S., the red line is Europe. Now, we drive more than people in the European Union. If you even just mentally factor or adjust for that, these lines would become noticeably closer together, but they would probably still retain the same shape or direction, and we in the U.S. would still have a higher fatality rate. So what gives is the issue here. Part two, first, let me just observe that our fatality rate in the U.S. Has been gradually declining over the 90s and very early 2000s. then it kind of leveled off. That leveling off, and even unfortunately, there's the impact of the pandemic probably. That leveling off, even slight uptick, coincides, and we don't think coincidentally, with the widespread adoption of smartphones. So don't text and drive, but from the 2008 to 10 timeframe into 2015, dramatic rise in the adoption of smartphones, and what do you know, that fatality rates kind of level off. We all know that you shouldn't text and drive, and that accidents that happen when somebody is looking at their smartphone tend to happen at higher speeds and have higher severities. But what's interesting is the folks in Europe adopted smartphones every bit as much as we did, and yet their fatality rate kind of continues to go steadily down. Maybe the decelerate, maybe a slower decline, but certainly it continues to go down. So what gives? Well, we think that the one answer might be in the chart below, which looks at manual transmission sales. So think stick shift cars compared to automatic. Manual transmissions sales as a percentage of all vehicles. And what it shows is that for decades now, the vast majority of cars in the US have been automatic. For decades, the vast majority of cars sold in the EU were standard shift. The estimate right now is that cars on the road in the EU are probably 75 to 80% standard, and in the US probably 10%, maybe even less standard. Therefore, 90+% automatic. Look at the tagline here. If you've driven a stick shift car, you know this. If you're shifting, you're not scrolling on your phone. So in an essay in our briefing, we said buy a stick shift and save a life. All this I'll just mention. If it goes, I should mention it, but it is meant to go without saying that we hope that you all, when seeing some of these connections, we're trying to think of ways you can study them at your own company. So in the last one, maybe you can get VIN numbers and look at fatality rates by VIN number, because VIN number would reveal whether a car had an automatic or standard transmission. So again, we always hope that this work is actionable, relevant and actionable for our readers. Home fires, or structure fires, I should say. The overall trend for structure fires has been flattish for most of this century, but there are some interesting differences. If you look at 1 and 2 family homes, we'll focus on the blue. 1 and 2 family homes have really it came down really sharply from the 80s and the 90s. And we think a large reason is the adoption rate in home smoke alarms during that time frame. But they've been flattish for most of this century, 1 and 2 family homes. But look at the non-home category. This is data from the National Fire Protection Association. In the non-home category, which includes hotels, motels, dorms, and similar structures, similar sharp decline in the 80s and 90s, but then flat and kind of rather undeniable increase over the last decade or so in fires in the non-home category. So again, perhaps there's from an underwriting, pricing, or claims perspective, some evaluation that could be done there if you're an insurance company. And we will end with this, which in the financial section of our Trendspotting piece in the January briefing. We find it interesting to look at earnings estimates as they progress during the course of a year, but typically earnings estimates for the year ahead and even 2 years ahead. So during 2023, we want to understand how analysts, who are always thinking about insurers, reinsurers earnings, how the information flow during 2023 shaped their view of 2024 and 2025 earnings, to be specific. So here you have on the left-hand side the changes in estimates over the course of 2024 through the middle of, 2023 through the middle of December. And we include the 2023 changes here, but we can ignore that for a minute. That'll be impacted by actual results. And you see that during the course of the year, analysts became more pessimistic about personal insurers' earnings in 24 and 2025, the red and the black respectively. makes sense. We kind of learned that inflation was proving sticky for auto insurers. Some of the trends were adverse, and they kind of, many of them really kind of delayed their return to the desired profitability levels. Um, Not a whole lot of information content or changes for commercial insurers, specialty insurers. There's been some concerns about their growth or trajectory of growth, but look at reinsurers. Look at how their earnings estimates, excuse me, both for 2023, but also 2024 and 25. But look at the way 2024 revised upwards by almost 30%. I think that shows a real conviction that analysts had that reinsurers had reshaped their exposure to natural catastrophes and pushed a lot of volatility back onto the earning statements of, in a lot of cases, personal insurers who saw their estimates go down. So it's not surprising those go in opposite directions. When we look at just, we shorten our time horizon and say, hey, what information came out of the third quarter, which kind of just only concluded within the last month or so as this is recorded. What's really notable here is that personal insurers, they're starting to become more conviction that the worst is behind the personal insurers, especially for auto, and that 2024 is looking better. We have kind of some of the major states that were identified as the laggards in approving rate increases. California and New York are really starting to approve meaningful rate increases now. That's helping to fuel this. Specialty insurers, again, kind of acknowledge that they couldn't grow at a 20 and 30+% clips forever, which it seems like it should be obvious, but some analysts maybe had them growing faster. But again, even as late as the third quarter, you still had analysts absorbing kind of information about reinsurers and revising their estimates higher. So listen, we hope you found that useful. There's more in our assured briefing, and we certainly encourage you to reach out to us if you'd like to receive a trial to our work. With that, we'll say happy holidays, and hope 2024 starts off well for all of you. Bye now.